In this video, we're going to talk about the importance of trading the right market conditions. Stay tuned. Hey traders, a very warm welcome to you. Okay, so I've talked about this before. If you haven't checked out my videos, go and check them out. If you're new here, consider subscribing. If you're here and you're a seasoned video watcher, welcome back. Okay, so trading the market, right market conditions. Why is it so important? So I've highlighted kind of some broad strategies that I know other traders trade, that I trade, that just are good strategies to trade, and matching them to the right market conditions. And I want to show you how it's very important. It doesn't matter, you know, the best strategy in the world, but if you haven't got the right market conditions, you will just not perform. It's as simple as that. And we talked about, you know, the fact of having the right strategy with the right psychology and balancing them both. This is now we're focused on having the right strategy. So the first one is if we're in a trend type environment. So let's say you're a money manager. A lot of hedge funds have this approach, trend trading. They will buy something because they believe that the company's maybe going to constantly improve on earnings. It's going to become a more successful company, or the economy as a whole is going to improve. And they might buy a currency pair or sell a currency pair, or they might buy a basket, an index commodity, or they might buy, sorry, an index future, or they might buy an ETF for a broad index, or same kind of thing with a commodity. They might say that, you know, there's more demand coming in. They're looking for the longer term trending cycles. Interest rates, another thing. So they just want a nice steady plod to one way or the other. So they get on board it, maybe they add as more money comes in. That suits them down to the ground. If you look at hedge fund performance, especially funds that are kind of looking at that strategy, they perform very well on those conditions and perform very poorly in other conditions. So let's look at some of the other conditions as well. So if you're trading mean reversion, what does that mean? It basically means you're trading extensions that have gone too far, one way or the other. You're trading and pull back to a central point. And that is perfect for a range bound market. So indecision. So that could be over a year period or whatever it may be. But the point is it goes to highs, goes to lows, goes to highs, goes to lows, maybe it goes to new highs, new lows, but it's not a clear trend. You know, if you're trying to trade a trend style value investing approach in a range bound market, you're going to lose money. It's just not going to be conducive to a profitable strategy for you. If you're trading mean reversion, i.e. you've got some kind of mean and you're selling extremes and you're buying extremes and you're just kind of playing that range, it's going to be very good for you. You're going to have a good year. Let's look at selling premium. So that will be something that if you're an options trader, a lot of options traders, excuse me, will sell what's called premium. So in other words, they're selling insurance. People buy options to, sometimes they'll buy options to have insurance on something that they're not sure of. Maybe there's earnings coming out, they want to protect a position, so they'll buy a call or a put option. Well, if they've got a stock holding, they'll buy a put option which protects them for a little bit of downside. And a lot of traders will sell those options because there's a premium involved in it. They kind of get a bit of insurance premium on top of the value of the option, and they can't make money generally unless there's uncertainty. The more uncertainty there is out there, the more demand there is for this insurance premium, and the more premium you can charge, and the more likely is you're going to make money. Now, if everyone's very happy and volatility is very low and premium is very low, yes, of course, you know, people do still do it and can make money, but they make more money, generally speaking, when people are a bit concerned and there's a bit more fear. The volatility component shoots up a little bit more and they're getting more return for every money they're spending. So if they're trying to do selling premium on a steady market, it's very slow, nothing's happening, it's not going to be very good for them. Whereas if they've got uncertainty, they've got maybe stocks that are doing this, doing that, a lot of uncertainty, then they can sell that insurance and still make a margin. They're not going to win every trade, but still kind of make some money over time. They're going to do far better. Another thing might be scalping. You know, if we're scalping, and that could be day trading for a few hours, it could be minutes. You know, you need, generally speaking, volatile conditions. You need to have those extremes where you can notice, you know, there's an edge there. There's a point where it just has gone too far, whatever scalping strategy you've got. You know, it's pushing too much, or you sense the momentum before it comes in. And so there are waves to ride. So if you're a day trader, you know, volatile conditions are very good for you. Obviously, too volatile, you've got to be careful that you're not overdoing the volatility. But generally, you need some movement. If you're buying momentum, it needs to carry on momentum. It can't just run out of puff and then just go quiet. Which is why if you're kind of day trader or scalper and you're trading something that's very, very quiet, very, very calm, it's harder to make money compared to a volatile environment, something that's really moving, something that's really kicking off to the upside or downside, but it's extending, it's pulling back, it's just got, in the midst of a whole day's move, it's got plenty of kind of sub moves that you can get your teeth into and get some juice out of the market. And the point is, if you try and bolt this strategy into one of these strategies into the wrong conditions, whilst you still can make money, you notice that the sweet spot comes when you've got the right market conditions for the right strategy. So point here is, check out the style you're trading, make sure the market conditions are matching up to that style. If they're not, maybe reconsider the market you're trading or the style you're trading. And if they are, make the most of it, and you can at least say, well, actually, I'm in the right market conditions, I'm trading the right kind of style and strategy. If I'm not performing, maybe there's something else I need to tweak. But this is the first kind of port of call. Make sure your style matches up with your conditions. And so that there is something to take out of the market at least, and you're not kind of trying to use a screw into try to hammer a nail into a screw hole or something like that. You get the point. Anyway, guys, comments in the comment section below as always, and keep the risk managed, whichever strategy you are using. Take care. See you in the next video. Goodbye.